Welcome to the Millennial Capital YouTube channel.
Hello everyone. Today, we're diving deep into a pressing topic that's been on the minds of many, the relationship between government ownership, taxation, and how it impacts our banks here in Sri Lanka. We'll also explore how different economic philosophies, such as capitalism and socialism, influence this dynamic. Let's start with a fundamental concept. Imagine a scenario where a company's profits are taxed at over 50% by the government. In essence, the government is receiving more than half of the company's earnings. So, who truly benefits the most from this company? Shareholders or the government? The argument is that while the assets of a company may nominally belong to the shareholders, the majority of the financial benefits are going to the government. In Sri Lanka, this isn't just a theoretical exercise. Our private banks are being taxed at around 52%. This means that for every 100 rupees of profit a bank makes, 52 rupees go to the government. While shareholders still hold the assets, it's the government reaping most of the monetary rewards. But here's where things get even more interesting. Sri Lanka has a mix of private and government-owned banks, such as the Bank of Ceylon, National Savings Bank, and the People's Bank. Now, some left-wing groups argue that these banks should remain fully under government ownership. But why would they want this, especially when the government is already benefiting immensely from private banks, without investing any cent in private bank? The answer, unfortunately, might have less to do with sound economics and more with power and corruption. When a bank is wholly owned by the government, it often becomes deeply entangled in politics. This can sometimes result in politicians securing loans with little scrutiny and not repaying them. Such acts would be much harder in a private institution, where accountability to shareholders is paramount. Now, let's talk interest rates, which are basically the costs you bear when you borrow money from a bank. Why is it important? Because it affects your monthly repayments. As you can see, the two government-owned banks, Bank of Ceylon and People's Bank, have interest rates of 18.3% and 19% respectively. Comparatively, most private banks have lower rates. This difference indicates inefficiencies in government-operated banks. You might be asking, why do government banks have higher interest rates? The reason is often tied to inefficiencies, bureaucracy, and less competitive practices in government-controlled institutions. This brings us to a broader debate between capitalism and socialism. Capitalism, at its core, thrives on private ownership and competition, leading to efficiency and innovation. It emphasizes accountability to shareholders and believes in limiting government intervention in business. On the other hand, socialism often pushes for more government control, aiming for a more equal distribution of resources. When banks in Sri Lanka are heavily taxed, or when there's a push for them to be entirely government-owned, we drift further from the capitalist ideal. While it's essential to have checks and balances, the potential misuse of power, especially in the banking sector, becomes a genuine concern. If we truly want to protect our economy and the integrity of our banking system, we need transparency, accountability, and a balanced approach that supports both public interest and private innovation. That's it for today. If you found this insightful, don't forget to like, share, and subscribe. Let's drive towards a future with informed choices and financial freedom.
Please don't forget to subscribe to the Millennial Capital YouTube channel. See you next time.